Welcome, savvy investors. Today we're diving into the world of high-dividend ETFs, specifically the 4 best ones to buy now. Let's begin by unraveling the concept of high-dividend ETFs. ETFs, or exchange-traded funds, are investment funds traded on stock exchanges, much like individual stocks. However, instead of purchasing shares in a single company, when you buy an ETF, you're buying a basket of different stocks, bonds, or other assets, offering a convenient way to diversify your portfolio. Now, high-dividend ETFs are a particular breed of ETFs that focus on companies known for their generous dividend payouts. These are typically well-established firms with a track record of consistently returning a portion of their profits to shareholders. The high-dividend label signifies that these ETFs specifically target those companies that offer above-average dividend yields. So, why would you consider adding high-dividend ETFs to your investment strategy? Well, there are a few compelling reasons. Firstly, dividends can provide a steady stream of income, making these ETFs particularly appealing for those seeking regular payouts, such as retirees. Even if the market takes a downturn, these dividends can provide a cushion, helping to mitigate potential losses. Secondly, these funds offer the benefits of diversification. Because each ETF contains a variety of different stocks, you're not putting all your eggs in one basket. This spread of investments can reduce the risk associated with investing in individual stocks. Lastly, high-dividend ETFs can offer potential for capital appreciation. While the regular dividends are certainly a highlight, the underlying stocks in these ETFs also have the potential for price growth, offering a dual benefit. In short, high-dividend ETFs can offer a blend of regular income and potential capital growth, all while helping to spread out your investment risk. They're a tool worth considering for any savvy investor looking to diversify their portfolio. Now that we've laid the groundwork, let's delve into our first high-dividend ETF, TLTW. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. TLTW, or the iShares Global Total Dividend Fund, is our first contender. TLTW stands as a testament to the power of global diversification in the realm of high-dividend ETFs. A product of BlackRock, one of the world's most renowned asset management firms, TLTW offers a broad exposure to dividend-paying companies from around the globe. But what sets this fund apart? Firstly, let's delve into its global reach. Unlike many of its counterparts, TLTW doesn't simply focus on the US or other developed markets. No, it goes a step further. It ventures into the emerging markets, tapping into the potential of high-growth economies like China, India, and Brazil. This global diversification provides investors with a unique opportunity to benefit from the growth of companies in various corners of the world. Now let's talk about its portfolio. TLTW isn't just diversified geographically, it's diversified across sectors as well. From technology, healthcare, and consumer goods to utilities, energy, and financial services, the fund's portfolio spans a wide range of industries. This sectoral diversification aids in mitigating the risks associated with overexposure to any single sector. It's like putting your eggs in many different baskets. If one sector faces a downturn, the impact on your investment is cushioned by the performance of others. But what about the dividends, you ask? Well, TLTW's attractive dividend yield is indeed a highlight. This fund has consistently provided a decent yield over the years, making it a preferred choice for income-focused investors. After all, who doesn't like a steady stream of income flowing into their account? However, just like any investment, TLTW comes with its own set of risks. One such risk is market volatility. Given its global exposure, the fund is vulnerable to fluctuations in the world economy. Any downturn in international markets can impact the value of your investment. But remember, with higher risk comes the potential for higher returns, and TLTW's diversified portfolio can help mitigate this risk to some extent. Another risk to consider is the currency risk. Since TLTW invests in companies around the world, it's exposed to various currencies. Any significant fluctuation in currency exchange rates can affect the fund's performance, but again, this risk is part and parcel of international investing. And for those willing to bear this risk, the potential rewards might be worth it. In conclusion, TLTW, with its global reach, diversified portfolio, and attractive dividend yield, stands out as a compelling option for those seeking high-dividend ETFs. But like any investment, it's essential to weigh the potential rewards against the risks. So before you dive in, make sure to do your due diligence, understand the fund's specifics, and consider your risk tolerance. Now let's move on to our second ETF, VPC. Next on our list is VPC, the Vanguard Global Capital Cycles Fund. VPC is a unique player in the world of high-dividend exchange-traded funds. The fund's investment strategy primarily focuses on capital cycle sectors. These are sectors that tend to follow a cyclical pattern, experiencing periods of boom and bust that savvy investors can capitalize on. The primary sectors VPC invests in include mining, energy, and telecommunications. Investing in these sectors involves a careful analysis of the capital cycle. This cycle starts when an industry experiences increased demand leading to higher profits. These profits then attract more capital, which is invested in expanding production. However, as production increases, supply begins to outstrip demand, leading to falling prices and lower profits. This in turn leads to a reduction in capital investment, and the cycle begins again. VPC aims to take advantage of these cycles by investing in companies that are poised to benefit from the upswing of a capital cycle. For example, a mining company that has invested heavily in expanding its operations during a downswing may be undervalued by the market. However, as the cycle turns and demand for minerals increases, this company could see its profits soar, providing a high return on investment for VPC shareholders. But like all investment strategies, VPC's focus on capital cycle sectors comes with its own set of risks. One of these is the sector concentration risk. This refers to the risk associated with having a significant portion of an investment portfolio concentrated in a single sector. If that sector experiences a downturn, the portfolio could suffer significant losses. For instance, if the energy sector were to experience a downturn due to a drop in oil prices, VPC's portfolio could take a hit. This is because the fund has a significant portion of its investments in energy companies. However, the fund's managers aim to mitigate this risk by diversifying across various sectors and geographies. Despite these risks, the potential for high yield makes VPC an attractive option for investors seeking high-dividend ETFs. The fund's focus on capital cycle sectors means it has the potential to generate significant returns during the upswing of a cycle. Plus, companies in these sectors often pay out a large portion of their profits as dividends, which can provide a steady stream of income for investors. It's also worth noting that VPC is managed by the Vanguard Group, one of the world's largest investment management companies. Vanguard is known for its low-cost, high-quality funds, and VPC is no exception. The fund has a low expense ratio, meaning more of your investment goes towards generating returns rather than paying for fund management. In conclusion, while VPC's investment strategy involves a degree of risk, the potential for high yield and the fund's focus on dividend-paying sectors make it a compelling choice for investors seeking high-dividend ETFs. As always, it's important to carefully consider your own investment goals and risk tolerance before investing in any fund. With VPC covered, let's explore our third ETF, SRLN. Our third high-dividend ETF is SRLN, the Spider Blackstone Senior Loan ETF. SRLN is a unique offering in the ETF universe. Instead of focusing on stocks or bonds, this fund is centered around senior loans. Now, you might be wondering, what exactly are senior loans? Well, they are a type of corporate debt that takes precedence over other forms of debt. In the event of a bankruptcy, holders of senior loans are first in line to be paid back. That's a comforting thought for investors seeking a degree of security. Now, let's add another layer to that. The loans that SRLN focuses on are floating rate loans. This means that the interest rates on these loans adjust periodically based on market conditions. This is a double-edged sword, however. On one side, when interest rates rise, the interest payments on these loans rise too, creating the potential for a higher income. On the flip side, when interest rates fall, the interest payments decrease, which could potentially reduce income. Despite the potential for fluctuating income, many investors find the floating rate feature appealing, particularly in an environment of rising interest rates. In such a scenario, SRLN could potentially provide a hedge against interest rate risk. However, it's important to remember that while this ETF may offer some protection against interest rate risk, it is not immune to credit risk. Credit risk is the risk that the borrower will default on their payments. While the senior status of the loans in SRLN's portfolio provides some protection, it doesn't eliminate the risk altogether. This is because the companies that issue these loans often have lower credit ratings. In essence, This means that they are more likely to default on their loans compared to companies with higher credit ratings. However, it's worth noting that SRLN's portfolio is well diversified with loans from various sectors and industries. This diversification helps to mitigate the credit risk to some extent. But just like any other investment, it's essential to understand the risks involved before making a decision. In terms of income potential, SRLN has a history of distributing a high level of income to investors. This is largely due to the high interest rates associated with senior loans. But remember, the amount of income distributed can fluctuate based on interest rate changes and the creditworthiness of the borrowers. So, to sum it up, SRLN provides exposure to a unique asset class, senior loans, with a floating rate feature that could potentially provide a hedge against interest rate risk. It also offers the potential for high income, although this can fluctuate. On the downside, there's the risk associated with the lower credit ratings of the borrowers, which could lead to defaults. As always, it's crucial to conduct thorough research and consider your own risk tolerance before investing. Now on to our final ETF, KNG. Last but not least, we have KNG, the Cboe Vest S and P500 Dividend Aristocrats Target Income ETF. This fund has a rather unique strategy that sets it apart from many of its peers. It doesn't just focus on any company in the S&P 500, it specifically targets those with a track record of increasing dividends. This approach provides a potential for steady income and a certain level of market risk mitigation that is quite appealing. Let's delve into the details a bit further. The Dividend Aristocrats are a select group of companies in the S&P 500 that have not only paid, but also increased their dividends for at least 25 consecutive years. These are typically large, well-established companies with a history of generating reliable cash flows. They are the kind of companies that have the financial strength to weather economic downturns and still maintain their dividend payments. By investing in these Dividend Aristocrats, KNG aims to provide a steady stream of income to its investors. This makes it an attractive option for those seeking to supplement their income or for retirees looking for a reliable source of cash flow. But income is not the only advantage of this strategy. By focusing on companies with a history of increasing dividends, KNG also aims to provide a degree of protection against market downturns. These companies are often more resilient in the face of economic headwinds, and their commitment to maintaining and increasing dividends can provide a degree of stability in volatile markets. However, like any investment strategy, this one is not without its risks. While the Dividend Aristocrats have a history of stability, they are not immune to market fluctuations. If the broader market takes a dive, these companies' share prices can also fall. And although they have a history of maintaining their dividends, there is no guarantee they will be able to do so in the future. Also, while KNG's strategy of focusing on Dividend Aristocrats can provide a degree of protection against market downturns, it can also limit the fund's upside potential. In a bull market, these steady-eddy companies might not keep pace with the high-flying growth stocks. So, while KNG can provide a source of steady income and some market protection, it might not be the best choice for those seeking to maximize their capital appreciation. Another potential drawback of KNG is its relatively high expense ratio compared to some other ETFs. However, for many investors, the benefits of its unique strategy and the potential for steady income and market protection outweigh this cost. In conclusion, KNG offers a unique strategy that focuses on companies with a track record of increasing dividends. This approach has the potential to provide a steady stream of income and a degree of protection against market downturns. However, like any investment, it comes with risks, and it may not be the best choice for everyone. As always, it's important to consider your own financial goals and risk tolerance before deciding if KNG is the right fit for your portfolio. That wraps up our list of the 4 best high-dividend ETFs to buy now. So there you have it, TLTW, VPC, SRLN, and KNG, 4 high-dividend ETFs that could boost your investment portfolio. Let's take a moment to recap. The iShares Global Total Dividend Fund, or TLTW, is a great option for those seeking global exposure. It focuses on high-dividend equities worldwide, providing a diversified approach to income investing. Vanguard Global Capital Cycles Fund, or VPC, is another strong contender. This fund offers a unique take on investing, focusing on sectors where capital investments are at low levels, promising potential for future growth and dividends. The SPDR Blackstone Senior Loan ETF, SRLN, offers a different approach, investing in senior loans. These are typically first in line for repayment if a company goes under, providing a layer of security. Plus, they usually offer a high yield. Finally, we have the Cboe Vest S and P500 Dividend Aristocrats Target Income ETF, or KNG. This fund targets companies within the S&P 500 index that have consistently increased their dividends for at least 25 consecutive years. It's a great option for those seeking steady, reliable income. But remember, while these high-dividend ETFs have potential, it's essential to consider your own risk tolerance and investment goals. The world of investing is not a one-size-fits-all scenario. It's all about finding what works for you, your financial situation, and your future aspirations. Consider these funds as you strategize and plan. Do your homework, and don't be afraid to reach out to financial advisors or investment professionals for advice. Your investment journey is unique, and the more informed you are, the better decisions you'll make. If you found this video helpful, please subscribe to our channel, like this video, and share it with your fellow investors. Until next time, happy investing!